All right, let me try to break down these ICT concepts, the ones that I trade at least. So what I like to trade is the ICT power of three concept. And I also like to trade the daily liquidity run. Okay, so let me see if I can break this down in about 20 minutes. In order to better understand what we're looking for, is we all have to be in agreement on how the market moves. Okay. When we're trading, we expect to see an impulse move, pullback, and then another impulse move, whether it's to the upside or to the downside. So the downside, you get an impulse move, you get a pullback, you get another impulse move. Either the market is trending up, the market is trending down, or the market is consolidating or moving sideways, right? Basically, equal highs, equal lows. Those are the three market phases. And depending on where you're placing your market phases, you can paint a picture. So there's a good chance that a consolidating market can turn into a market that's on a downward spiral. There's also a good chance that before that market started consolidating, that maybe it came from a lower level. So when you put all those phases together, you get a market that pushed up, it consolidated, and it pushed back down. Okay, so if we can all understand those basic concepts, now we can get into the actual breathing, functioning market. Okay, so I like to zoom out on my charts, right? So if you can zoom out as far as you can zoom out on this US 30 or any other chart, and I wanted to throw a fib on this move. We have an impulse move up here to the top side, right? If you understand anything about trading, once you get an impulse move, in order for us to go higher, we have to pull back, right? And when we pull back, we want to pull back to this golden zone. And if you notice, we came close back in October of 2022, but we didn't make it, right? So just from observation, right? Not only did we not make it, but the push back up did not break these highs, which tells me as a trader that we're going to head back down, right? Now, this is very long term, right? So this is a daily chart and it's zoomed way out. So if you want to get more active or more involved, you'll zoom into a time that's closer to us now. So we have a low, a lower low, and then we have a higher low, which makes this area a swing low. These are important for ICT. I also see on this impulse move, we broke this high right here. So anytime a market impulses and breaks a high, I want to see a pullback. So now I'm going to fib this move. And if you see from this wick to the highest wick, the pullback is to our golden zone. So the next thing I would expect to see is for this next impulse move to push up to the negative 27, which will be about equal highs for here. So either we're going to make it up here, right? We're going to make it up here or we're not. The thing that bothers me, though, is when I look at where the market is now, from this impulse move, it fell short of these highs. The market just fell short. So as a trader, I'm interested in this high and this low. Let me change the color. The red lines are my levels of interest, right? If I'm looking at the daily and weekly, actually this would probably be on a monthly scale, but these are the highs and lows that need to be broken before I can tell what direction the market is taking long term, right? There's plenty of trades that can take place in between here, but this is the level that's of interest to me. So what I want to do is I want to throw a Fibonacci from these lows to this high and see if we've had a sufficient pullback. And now when I zoom in here, you can see that from this high, this low to this high, we've not pulled back to the golden zone. We've not pulled back. So that means the market needs to push down into this zone, maybe even to the 78.6. And you'll hear ICT refer to this 78.6 retracement as the OTE, optimal trade entry. Okay, let's dig a little bit deeper into the concept. When you understand what happens during these impulse moves, we call this an expansion. The market is consolidating, then the market expands to the upside. Well, during this expansion, the market leaves behind what they call imbalances, right? You have to understand what an imbalance is, or a fair value gap, to trade ICT's concepts, right? So let's talk about the relationship between each individual candle. Every 3 candles needs to have a relationship, right? So what do I mean by that? The wick from this candle, I'm just going to hit the replay mode because we want to talk about it. Notice this candle doesn't have a wick. This candle, the wick pushes down, price goes up, it comes here. What do you expect from this next candle? You expect that the wick from this candle will push down to the height, to the top of this third candle, right? Because 1, 2, and the next candle will be a third candle. The wicks need to touch. So let's play it out and see what happens. Look at that. The candle wick comes all the way down and touches. Perfect. That's exactly what we want to see as traders. This next candle, right? The wick of this third candle is during the body of here. So these 3 candles have a relationship, which is great. So now you have this candle, this candle. We expect the wick of this next candle to push down to the wick of this candle. And we can see it doesn't. It leaves this space, which we call an imbalance or a fair value gap. This is what we look for as traders. So wherever this push is going, right, we're going to allow this push to push all the way up. All right. So notice how this push breaks the high over here, right? The body of this candle closed above the body of this candle. I'm not really worried about the wicks, right? But I'm more concerned about the body. When the bodies close higher, that means we broke this high. I expect a retracement. And the market, by throwing me this red candle, is telling me that it is ready for a pullback. At this point, I can throw my Fibonacci on the chart. So I'm measuring from this wick of this impulse move to this high wick. And when it pulls back, I want to see price pull back into my golden zone, right? Now, you notice we just made this box. If it pulls back into my golden zone, it will close this imbalance. So let's watch. Price went higher. I'm going to have to adjust my fib. But now it's coming down. So now let me adjust my fib to the height. Okay, so now it just needs to pretty much come back to the box still. Let's play it out. Here comes price, here comes price. It shoots up and goes higher. Here comes price, here comes price. And that's where we stopped, right? So price never made it to our area, right? It touched the 50%. But we expect price to come down here. Now, if I look on the weekly chart, this is a bearish order block saying the market needs to drop from this weekly. Now, there are elements that we need to take care of up here as far as price that needs to be handled. But notice that this weekly chart is telling us that price is going to push down. There's no surprise to me that it's going to push down because it needs to push down into our box to take care of that imbalance, right? Because that's what we understand as traders. When you leave an imbalance, it needs to be filled, and that's where you take another buy from as the market pushes up. Now, let's talk about a lot of what ICT talks about when we talk about relative equal highs. I want you to take a look. This at the end of the week of April 10th, price is about at 34,115. The very next week, which is April 23rd, the price comes up and it goes right past 34, 111.14, or the first week it closed, or price got as high as 34,107. The next week it got as high as 34,119. That's intentional. It wicked those highs. It wicked it. The third week, price wicked the previous week at 34,119. It went to 34,134 and pushed down. The next week when price opened up, it took all the liquidity. Price pushed up, then it dropped rapidly. So anytime you have relative equal highs or relative equal lows on your chart, you want to put a line there when you're doing your analysis. If you would have put a line here, you would have understood that when price opened up, if your bias was for price to fall, you knew it was going to wick past these highs, because these relative equal highs equals people going short right here, and they put their stop losses. So the market is going to wick up. Also, people feel like, this is resistance. So they will put their stop losses here, or they'll put their buy stops here, because you break resistance, they believe that you're going to the next level. So they'll have a buy stop, and the price will trigger their buy order. They'll be in profit. The next thing you know, the market reverses, very fast, and it takes them out. So that's what he means when he's talking about relative equal highs and relative equal lows, and that's a draw. That's what the market is drawn to, right? And if you look at here, this is the same thing. Now, mind you, this is the daily chart, but this happens on every level, right? So this level right here represents the relative equal high. 1, 2, 3, 4, 5 weeks in a row, it was respected. That 6th week, price wicked all those guys out of the market and dropped. So if you understand the ICT's power of 3, all that means is you're going to have accumulation. The market is going to go one direction to take liquidity, and then it's going to push hard in the opposite direction. That's the power of three. That's exactly the way that I trade these weekly candles. And here's an example. This is a bearish order block, which means price broke structure, going to the low side. What's going to happen this week? When the candle opens, the market is going to buy up first, right? It's going to buy up first. It's going to induce people who don't know what they're doing to buy the market. At some point in the week, it's going to turn around and drop, taking those people's money because they don't understand or they're not looking at the market from a far enough distance out. The market doesn't just open up and go in that direction generally. It goes the wrong way first, then it goes in your opposite direction. So those are the ICT concepts. And you might ask, well, Todd, how do I know how far it's going to go? You drop down on the chart. Once I see from this weekly time frame that I have a bearish order block, right? I can drop down 2 time frames, not the daily, but the 4-hour. And on my 4-hour, right, I'm expecting the pullback to be 50%, right? So if I measured this weekly candle, if I put a Fibonacci from this wick to the lower wick, it's going to show me where my pullback areas was, right? And what I came out with was this area up here. Now notice there's a huge imbalance. Remember, this candle didn't open and go all the way back up here to touch this candle. So the market has to come and push into and close this imbalance, right? So this is my area of interest for it to come, touch, and then sell. Or maybe it comes through there, touches this bearish order block, and then sells. That's one scenario. It's a perfectly viable scenario. But if you notice, I have other areas marked on the chart just in case I don't get the sell from here. It might push up, right, to this 1-hour. I labeled it. This is a 1-hour fair value gap. If I go to the 1-hour chart, you'll remember if you look at this chart, you'll see this candle has a wick to here. Then you get the impulse candle. The next candle does not go all the way up to this wick. It leaves a fair value gap. So price will have to eventually come and close this fair value gap before going further. Because the way the market works is you get your impulse move, you get a pullback into the fair value gap, and then price drops. In this case, if you were trading the 1-hour chart, it would not have pulled back into your fair value gap, so you might have missed your entry on that chart. But all that means is sometime in the future, price will come back up into that fair value gap and trade away from it again. Hopefully you understand this concept. So it doesn't matter what time frame we're on. This works on the weekly, it works on the monthly, 2 months, 15-minute, 5-minute, 30-second. The concepts are all the same. You get an impulse move, you get a pullback to mitigate your positions here. In this case, the market kept going and gave you an impulse move down. Now, once you break structure, this is structure. Once you break structure from your impulse move, once this impulse move breaks structure, me as a trader, I want to see the pullback, right? And when this pulls back, I want this to pull back 78%. Here's the order block that sponsored this structure break. Or actually, you can say this is the order block that sponsored this structure break. So I want to see price pull back 78% to right here, to this imbalance. That's my optimal trading entry. You're not going to get it all the time. And if you don't, that's cool. You don't take the trade. Maybe you can figure out a way to get in at another point. But you notice this pullback was sufficient because it came past your golden zone. It came to your, at least to your golden zone. This is what you want to see as a trader. You want to see the market push, retrace, and continue pushing. Now, ICT doesn't want to enter a trade unless the pullback is to his optimal trade entry, which is his OTE, and that would be right here. So if you trade his concept and you're only interested in trades that pull back 78%, you won't get as many trades, but the ones that you do take will be very lucrative. Okay, I think I've covered all that I needed to cover as far as this is concerned. One more thing, I know we're a little over 20 minutes, is the daily liquidity run, right? If you go and look at your daily chart, and this doesn't matter what pair you're looking at, right? If you notice on these daily charts, you're going to have levels of equal highs or equal lows, right? I want you to look where these bodies are. That's equal highs. So I'm going to cover the wicks of these candles. Now I want you to look and see what this last candle did. If you ever see a wick of daily highs, you sell the hell out of it, because look at the massive pip count that this gives after it wicked those highs. Look how far this market traveled to the downside. If you can catch these moves on the daily chart, it works on any time frame, but the daily chart is significant because of the pip count that you get after this move. It's crazy. It's crazy. And you can do the same thing on these lows down here, right? You have an area that has relative equal lows. You got them here. You get a wick, price runs way up here. This wick made this relative equal lows. These are relative equal lows, right? This wick and this wick. It gets wicked right here. Look how extreme the price runs. So this is an ICT concept called the daily price run, right? Stop hunt high, stop hunt low. You'll hear it referred to as different things. But if you can go to your charts and you ever pick this up, if you ever see this activity, you're gonna get paid a lot of money just trading the daily price runs, right? You get a low here, you get a wick, price runs up. I'm not going to use those. That's not a great example. These are relative equal highs. Eventually, price comes right above there and pushes down, but it's not done in the wick. I want to show you the wick moves. The wick moves. There are several wick moves throughout here. You get all these relative equal highs. You get a wick. Market, the bottom falls out, come back up. You get relative equal highs. This is just a pullback, right? From this wick move, the market pulls back 78%. This is the optimal trading entry. And then look at this. Look at this crazy candle that pushes down. Unbelievable. Unbelievable. So if you just go and back test those ideas, it will probably open your eyes to a lot of things. And maybe you've even noticed some of these things in your trading thus far. But now that you have have the constructs in layman's terms, let me know if this starts to make better sense for you. All right.